Welcome you all for the session on national income. In this session, I am going to explain about the meaning of national income, important concepts associated with the national income, and the methods to determine the national income. So, it is important to know about national income. National income is the total value of goods and services produced in a particular country during a given period of time. Normally, it is calculated on yearly basis. So, it is used to know about what would be the growth of a particular country during a given period of time and what would be the standard of living of the people who are living in the particular country. So, likewise, the national income is an overall aggregate of the goods and services produced in a particular country, and it also serves as a medium for measuring the growth, understanding the standard of living of the people, and what would be the overall output generated in the particular country, and what are the activities in which the country has involved. It is like export and import activities, and what would be the income generated in the foreign country. It is like net factor income from abroad. Likewise, there are a different parameter are going to be measured by understanding the concept of national income. So it is in general we understand the national income. It is about the total value of goods and services produced in a particular country during a given period of time. It is normally for 1 year of time it is calculated. So need to understand the meaning of national income. National income is the money value of all goods and services produced by a country for a period of 1 year. The national income consists of the collection of different types of goods and different types of services rendered in the particular country. So it is the way in which the national income is calculated. As per the definition given by the Professor Marshall, the labor and the capital of a country acting upon its natural resources produced annually a certain amount of net aggregates of commodities, material and immaterial including a service of all kinds together is taken for the calculation of national income. So in this definition itself, you are able to understand the concept of national income. It is calculated in terms the involvement of labor, involvement of capital in a particular country, in terms how they are using the natural resources available in the particular country for producing the goods and services which are required in the particular country. So how those national resources to be converted or to be used for the productive purpose is calculated under the national income. And there are different reasons for calculating the national income. For the purpose, we need to understand the economic growth, whereas the country needs to know about what is their current status in their business cycle. It is compared to all over the world. It is required for understanding about the trade cycle, what would be the position of a particular country. And there is a changes to average living standard of the people. So what would be the purchasing power of the people in the particular country? It is calculated by taking an average. It is used to know about the purchasing power of the people and how those resources produced by the country has distributed the resources to its population. So the kind of things we can be able to understand by calculating the national income. And looking at the distribution of national income, it is measuring the income and wealth inequalities, where the kind of economic system followed by the country, they can be able to understand, they can be they can be distribute the income accordingly. Either it is differ from the pure market economy or it is differ from the mixed economy. So it is like the capitalism or nationalism, or it is like a socialism. The kind of mixed economy, it is differ, it is aggregate of all the things. Accordingly, the distribution of income and distribution of wealth may happen in the particular country. If there is any inequality, the kind of measures are going to be taken by the government in order to bring the equality or the inclusion in the financial system. And there are important concepts needs to understand to know about the national income or to measure about the national income. So there are concepts or like the gross domestic product, gross national product, net domestic product, net national product, personal income, per capita income and personal disposable income. or the important concept need to see to understand the concept of national income. So the first one, gross domestic product. So what is gross domestic product? The gross domestic product is the money value of all final goods and services produced in a particular country. It is especially which are produced or manufactured in a particular territory of a country, which we call it as gross domestic product, which is we are normally taken for the accounting year for this calculation of gross domestic product. So how this gross domestic product is calculated? It is taken few important variables into consideration for calculation of gross domestic product. It is C plus I plus G plus X minus M. So what are these variables? So the first one, the C, it stands for the consumption expenses, the total consumption expenditure in the particular country. So what would be the income generated by the particular country or the citizens of the particular country, the households, industries, so how they are using or how they are spending those income towards the consumption. So what would be the value of goods and services purchased in the particular country, which are produced by the industries, so how the households are purchasing. So based on that, the consumption expenditure, the total value of goods and services purchased in the particular country is calculated. We call it as consumption expenditure. Then second one is investment expenditure. The portion of a fund or the portion of income is spent in the form of investment or stored in the form of investment. It is going to be invested into the capital market. So will be calculated during the given period of time. What would be the portion of income is kept for the future purpose. It is invested into the market. So the total value is calculated. So the total value of money deposited into the banks, deposited into the post office, deposited into the or invested into the capital market. Likewise, together all the values are taken into the calculation for understanding about the investment expenditure happens in the particular country. And the G is a government expenditure. So in this government expenditure, it is calculated the total value of goods and services consumed by the government. So it is provided by the government to the people or the government directly consume that particular service from the people. So it is calculated the total value, together it is added into the government expenditure. And we can include the net factor, or we can say it is a balance of payment. It is like the export minus import. So what would be the total value of export happens in the particular country during a given period of time? And with the same time, what about the value of products or services received by the particular country? So it is a net aggregate value we can calculate, we can include in the gross domestic product. So the gross domestic product is calculating from the point of view of expenditure. That the expenditure, it is calculated the consumption expenditure, government expenditure, investment expenditure along with the balance of payment. Along with that, we will be calculating the export minus import, the total value of goods exported from the particular country during a given period of time. It is subtracted from the import. What would be the total value of goods imported in the particular country during the given period of time. And the GDP we are calculating, there are two important concepts or two important measurements. We are measuring the concept of gross domestic product. It is calculated on the basis of market price, and it is calculated on the basis of factor cost. There are two important aspects. The measurement, we are calculating the gross domestic product. In that, the gross domestic product is calculated. The final value of goods and services also includes the indirect taxes and exclude the subsidies given by the government. So in that value, it is calculated. It is what we calculated. The GDP is calculated at the market price. The current price, the GDP is calculated. The prevailing price, the GDP is calculated. So while calculating the prevailing price, we need to include the indirect taxes which are associated with this. It means that the particular product available in the market, if we are going to calculate that particular product, it is not we are going to calculate one particular product, we are going to calculate the aggregate of product. So what are the aggregate of product? The essential goods are available in the market. What would be the price in which the consumer pays and purchases the particular product from the market? In that particular price, it is calculated what we call it as the market price, calculation of gross domestic product. And we are just exclude the subsidies given by the government. There are some subsidies given by the government which is adjusted with the market price. some more product, let you take the example of public distribution system. In that the PDS, in that the ration shop, you are buying a product where the product is available lesser than the market price. There are the subsidies are given by the government for the people, which the government has classified the people into the priority household or non-priority household. So the priority household, they are giving the subsidized products. They are giving a subsidy on the essential goods, so the people can buy that particular product with respect to meet out their standard of living or meet out their requirement. For that purpose, they are purchasing the goods from there. There they are giving a kind of the subsidies which can be availed while you are purchasing or booking a cylinder for the domestic purpose. You can avail the subsidy. So the kind of subsidies are reduced. It means the GDP is calculated at what price the consumer pays to buy the particular product. It means which inclusive of taxes and excluding of subsidies. So in that particular concept, the GDP is calculated at the market price, and the GDP is calculated at the factor cost. It is calculated the money value of final goods and services. It is based on the cost involved in the process of production. In that value, the factor cost, with that what would be the factors are deployed for producing that particular goods or rendering that particular service. At that particular cost that the GDP is calculated, we know that is a factor cost, the calculation of GDP. So the GDP is calculated, the gross domestic product at the factor cost, it is calculated on the basis of gross domestic product at the market price minus indirect taxes plus subsidies. Together it is calculated on the factor cost. It means at the production cost. It means at the cost in which the producer is going to give the product to the end consumer. At that particular cost we are going to calculate. So that is what the reason we are subtracting the indirect taxes. Still the government subsidy is also given for the people who are underprivileged or getting the benefit from the government. So still we are taken into that the calculation of factor cost. So the GDP at the factor cost, it is derived from the GDP at the market price or GDP at the current price, and we are subtracting the indirect taxes and we are adding the subsidy given by the government. It means the total cost incurred for the government or the industries to produce the goods or giving the goods to the end user. So at the side of producer we are calculating this price. And the gross national product is a concept we are measuring. The GNP is aggregate value of final output of citizens and the businesses of an economy in a given period of time. It is the GNP is defined as the sum of gross domestic product and the net factor income from abroad. Together we can use to calculate the gross national product. In that, the gross national product, it is simply we can calculate from the or derive from the gross domestic product. Just we are together adding the net factor income from abroad. Or we can expand this, the gross domestic product is furtherly divided into the C plus I plus G plus X minus M. It is, you all aware the concept, it is calculating the total expenses in the particular country for a given period of time. It means the consumption expenditure plus investment expenses plus government expenses plus export minus import, the net value of foreign trade. Net value of foreign trade, or what we can say is the balance of payment, will be taken along with, we can take the net factor income from abroad. So need to understand the concept of net factor income from abroad. It means the factors rendered by the domestic country to the foreign national, or the foreign national offering the factor to the domestic country. With that two things, we are paying or we are receiving the income from the foreign country. So if the people who are migrated from the domestic country to the foreign country, they are getting the income. So that income is taken as an income received from the foreign country. It's similar to that, the domestic country, the foreign people are hired for that the purpose of the technology upgradation or some other purpose, we are using the foreign people or foreign citizens. So we are paying to those people. So the kind of expenses have happened. So it is a net value. We are calculating the net factor income from abroad. It is not only calculated on the basis of the labor. It is also calculated on the basis of land, labor, capital. Together it is calculated. Together it is overall calculated the value, what would be the service provided, what would be the service received. The net value, we call it as net factor income from abroad. Conceptually, we can say the net factor income from abroad is a difference between the income received from abroad for rendering the factor services and the income paid towards the service rendered by the foreign nationals in the domestic territory of the country. So together we can calculate the net factor income from abroad. So the gross national product is calculating what would be the factor income generated by the country during the given period of time. Net factor income is calculated along with the gross domestic product for this calculation. And the net domestic product and net national product, we need to see, we need to know that the net domestic product or the concept, how it is derived. So we can take one particular value in this, where we can use the capital goods for manufacturing or producing goods and services. So those capital goods, we can take the capital goods or having a depreciation, or we can give the depreciation allowances to the capital goods for the purpose of further replacement of the capital goods in future. We can allow some depreciation. So the depreciation allowances is also called the capital consumption allowances. So that is taken effect in the net domestic product as well as for net national product. The two things, the depreciation has an impact. So the calculation of net domestic product, it is calculated on the basis of gross domestic product minus depreciation. So the gross domestic product is calculated on the basis of consumption expenditure, investment expenditure and government expenditure plus export minus import. It is calculated. Along with this, we subtract the depreciation allowances or capital consumption allowances during the given period of time. So how much the machinery is used. So what would be the total value of depreciation we can allow for those machineries which can be deployed for the purpose of producing goods and services in the particular country. So that we can take into the calculation, we can take it for the depreciation. And the net national product, the net national product is calculated, it is GDP minus depreciation plus net factor income from abroad. It means simply we can say the GNP minus depreciation. It means we are expanding this particular formula. We can get the capital expenditure, what included in this. We can get the depreciation and we can allow the depreciation for the calculation. So it is calculated on the basis of consumption expenditure, government expenditure, investment expenditure plus export minus import minus the depreciation or depreciation allowances or capital consumption allowances plus net factor income from abroad. In that particular basis, we are calculating the net national product. The net national product is an actual addition to the year's wealth and the sum of the consumption expenditure, government expenditure, net foreign expenditure and investment less the depreciation plus net factor income earned from abroad. In that particular basis, we are calculating the net national product. And the per capita income, that the per capita income is a portion of income, the portion of national income which is available for individual or whatever the income generated by the particular country over the period of time is distributed among the people living in the particular country. So in that particular basis, the per capita income is calculated. So the per capita income is calculated. The per capita income is an average income of the people of a particular country during a particular year. It is the per capita income is equal to national income divided by the total population in the particular country. that particular basis the per capita income is calculated. It means simply we can say the per capita income is the total value of goods and services produced in a particular country during a given period of time. It is distributed among its population. So what is the overall population of the particular country? It is distributed. So per individual, what would be the income distributed by the country is known as the per capita income. The personal income is calculated. The personal income is a total income received by the individual of a country from all sources before the direct taxes in 1 year. It is calculated. The personal income is calculated from the national income. The national income minus undistributed corporate profit minus corporate taxes minus social security contribution plus transfer payments plus interest on public debts. Together we can be able to get the personal income or household income. What would be the income generated by the household during the given period of time? It is calculated. It's the concept, we call it as a personal income. It is the total income received by the individual of the country. It means households of the particular country. So it is calculated after deducting all the expenses. It means the contribution by the companies, the contribution by the government, or we can subtract from the total or the national income, we can get the personal income. The personal disposable income is an income which can be spent on consumption by the individuals and families, the household, the total value of the amount or the income which can be spent for the purpose of consumption, which we call it as a personal disposable income. The personal disposable income is calculated from the personal income minus personal taxes. Together it is calculated. Or otherwise, we can say the personal disposable income is calculated the total value of consumption. The consumption value which together included the savings, the portion of savings. Together it is calculated. The portion of saving is also considered as a expenses towards this particular calculation. And the real GDP and nominal GDP. Need to understand this concept. Then only we can be able to know what would be the growth generated by the particular country during a given period of time. It is calculated on the different perspective. So the base we are calculating on the real GDP and nominal GDP. So what is the nominal GDP? The nominal GDP is income estimated at the prevailing prices called nominal GDP. So what would be the price that the particular product is available in the market? What is the price, the current price of the product we are calculating, which we call it as a nominal GDP. And the real GDP will be calculated, the national income is measured on the basis of more fixed prices. Say the price is prevailing on the particular point of time, or by taking a base year is known as a national income at the constant price or real GDP. It means the importance is also given to the rise in price level for the particular product during a given period of time. It means the effect of inflation is also taken into consideration while calculating the real GDP. The real gross domestic product is calculated on that particular basis. So that is what the purpose we are taking the base year into the calculation. For that the base year, what would be the current year price, together we can calculate the relationship has been measured or the ratio is being calculated for the further calculation of real gross domestic product. So the real gross domestic product, it is adjusted towards the inflationary effects. So the GDP deflator is the relationship between the nominal and the real value. So it is calculated, the GDP deflator is equal to nominal GDP divided by real GDP multiplied with 100. We can be able to understand what would be the fluctuation, the volatile movement of the gross domestic product of a particular country. It means that particular effect, we can say the inflationary effect which prevailing in the particular country. If the nominal is equal to real, it means the currency, what would be the value generated by the country is able to use for the further purpose, but it is not, if there is a kind of deviation, is measured in terms of GDP deflator by the calculation of nominal GDP divided by the real GDP in the particular country. And the GDP deflator is the measures the changes of the price between the base year and the current year. So that is how the prices of the products are available in the base year. If we can say the example, if it is calculated on 2012 or 2011 as a base year for 100, now the overall product are available in the market for 150 rupee. There are about the 50% changes in the price level. So the GDP is measured on that particular basis. We can know that it's a GDP deflator. 5 alternative measures of income. In this 5 alternative measures of income, how we will calculate the gross national product at the rate of market or at the prevailing rate, how to arrive the personal consumption. So it is going to be explained in this session through the different component or represented in this particular diagram. So let me take how we are calculating the gross national product at the market price. So you aware what is gross national product at the market price. So the market price is a prevailing price. So market price is a price at which the consumer are buying the product or availing the service from the market. So that particular price is taken for the calculation. So in that particular price, we are calculating the overall goods and services produced in a particular country during a given period of time. Along with this, we have taken the net factor income from abroad. It means what services we have availed from foreign country, for that we have paid the amount. Similar to this, what are the factors have been used or factors have been rendered from the domestic country to foreign country, thereby we have received the income. Together we have added to arrive the gross national product at the market price. So what are the important components of the gross national product at the market price? That together included the government purchases or government spending, together the gross private domestic investment towards the investment expenditure and the consumption expenditure, and we have added the net export. It means the export minus import. Together we have calculated the overall the goods and services, the value of goods and services produced in a particular country. The second important concept with this value, total of this value, if we have subtracted the depreciation or allowing for the depreciation allowances, or we call it as capital consumption allowances. If we are subtracting this, we may get the net national product at the market price. So in that net national product at the market price, if you are subtracting the net indirect taxes, whatever the net indirect taxes have been paid, if we are removing this, we may get the national income. We are calculating the national income. It is on the basis of net national product at the factor cost. It is at the price in which the producer offer the goods and services to the consumer. So at that particular price, it is calculated by subtracting the indirect taxes. So with that effect, we are calculating the national income. So the national income is calculated on the basis of net national product at the factor cost. So together the other cost, what included in this for the calculation of net national product at the factor cost for determining the national income, it is including the corporate profit, together the rent, interest and the proprietor's income, together the wages are calculated for determining the income received by the country during the particular period of time. Along with this, if you are subtracting the corporate profit and social insurance and taxes, the social security benefits and the taxes, if you are subtracting, along with that you may add the transfer payments and interest and dividends given by the company. Together if you have added, you can arrive the personal income. The overall personal income can be arrived. If in that the particular personal income, if you are subtracting the personal taxes, you may get the disposable income, disposable personal income. It means together the consumption expenditure, together the savings are the major component in that the disposable personal income. In that disposable personal income, if you are subtracting again the personal saving, you may get the personal consumption expenditure. So what is the total personal consumption expenditure together used or together can be availed by the people in the particular country? It is the aggregate value of the households in the country, how much they consumed in the market. So it is calculated under the basis we know that is a personal consumption expenditure. So together these are the 5 major alternative measures of income. In that we can be able to calculate the national income, personal disposable income and consumption expenditure. It can be calculated out of this. And there are measurements of calculating the national income. There are 4 important measurements and we used for calculating the national income. Before this measurement, what we have identified, we have another set of measures to calculate the national income to understand the movement of funds or understand the movement of cash flow between the different entities of the economy. So we can have the 2-sector economy, 3-sector economy and 4-sector economy. Together in the 2-sector economy, households and the firms are there in the economy. So how the flow of goods and services and rendering of factor services that happen in that the particular economy is calculated under the 2-sector economy. While we take the 3-sector economy, in addition to that the role of government is there in that the particular economy. So with that the role of government, so what would be the benefit provided by the government to the firms, and firms how much they are paying in the form of taxes to the government. So similar way the individuals or households, what would be the benefit received from the government and how much the tax paid by the individuals to the government is calculated under the 3-sector economy. And the 4-sector economy along with this household, firm, government and the foreign sector. So in that the particular foreign sector along with this, so what would be the contribution of foreign sector? It is export and import. What would be the benefit to be realized in that the particular economy? So this is one set of calculation is understanding the national income is based on the circular flow of money. So how the movement of money is there in that the particular economy. So it is to be identified the income generated by the country over the period of time based on the different sector of economy. So the next set of the method what we are using is the measurement of national income is based on the 4 different methods. First one, output method, expenditure method, income method and value added method. So these are the 4 important methods have been used for the purpose of calculating the national income. So the first one, the final product approach, involves the estimation of market value of final goods and services produced in the economy for a given period of time. So it is calculated, it is what we call it as output method or a product method. In that the product approach, how we are estimating, the national income is based on the market value of final goods and services produced in the economy for a given period of time. So the market price, the total value of goods and services produced in a particular country is calculated under the output method. So in India it is known as the inventory method or it is a product method. In this particular method, the economy is classified into the 3 major transactions happens in the economy. It is, we are classifying on the basis of industrial sector, services sector and we are classifying on the basis of foreign transaction sector. So in that the foreign transaction sectors, international payments are also considered when we are doing the calculation. So this particular method we call it as output method. So how to arrive this output method? There are steps involved in the final product approach or the product approach or the output approach. So in that first one, need to calculate the market value of all goods and services produced within a country for a given period of time, and it estimates the gross domestic product at the market price. So the final price, we are calculating the overall expenses which happens in that So based on the overall goods and services produced in the particular country is taken. So the number of goods manufactured in industrial sector or the output of industrial sector multiplied with the market price. And calculating the overall services sector, how much the unit are manufactured, how much the services, amount of services are rendered, together the value is calculated. And together the foreign transaction, how much the net transaction happens in the particular country during the given period of time, together is calculated for arriving the gross domestic product at the market price. The second important aspect, in addition to this, need to add the net factor income from abroad. It is in that GDP we need to add the net factor income from abroad. Finally what we get, net national product. It is we can get the overall, the gross national product at the market price will be calculated. So this is a particular method what we are used to calculate the product approach or the final product approach or the output based method to determine the national income. So in that output based method to determine the national income, we are calculating the overall goods and services produced in the particular country during the given period of time. So in that calculation, the output based calculation, we are measuring the output on the basis of final value or on the basis of market price. We are calculating market price of goods produced under the industrial sector, market price of services rendered, and the market price of foreign transactions happens in the particular country. Together the value is taken for the calculation of gross domestic product at the market price. The second step, you are going to add the net factor income from abroad. So whatever the service we have rendered to the foreign country, thereby we have generated the income. Thereby we are offering or we are providing the land, labor, capital and entrepreneurial activity or to be conducted. Thereby what would be the income generated and what would be the kind of services realized from the foreign nationals. For that, what would be the income paid by the country. Together we can take or together we can subtract the income received minus income paid. Together you can get the net national income from abroad. So with that, the gross domestic product of market price, together we can add plus the net factor income from abroad, you can get gross national product at market price for the calculation. And in this, there are deduction of the depreciation from the gross national product at the market price, so that you may get the net national product at the market price. So there are depreciation allowances or the capital consumption allowances are subtracted from this gross national product at the market price. You may get the net national product at the market price. Finally, there are deductions of net direct taxes, net indirect taxes from the net national product at the market price. It may give the net national product at the factor cost. Finally, you may arrive the net national product from the factor cost will be arrived for the calculation of output method. So what the value in which the goods and services are produced at the factor level we have been calculated. And the expenditure method, in that the expenditure method, the total amount spent on the goods and services produced in a nation by their households, firms, government and the foreigners. So it is based on the expenditure method, it is calculated, and the Professor Samuelson calls this as the flow of product approach. Flow of product approach. In India it is known as outlay method. We call it as outlay method. In that will be taking the household, in that the household we are calculating the consumption expenditure, then the firms we are calculating the investment expenditure, the government we are calculating the government spending or the government expenditures, and the foreigners we are calculating the export minus import or export import. What would be the difference? It is calculated. It is together what we are calculating the consumption expenditure, investment expenditure, government expenditure plus export minus import. Together we have calculated for arriving the total expenditure in the particular country during the given period of time. It is calculated. And the steps involved in the expenditure method, together we are using gross domestic product at market price is calculated. So together we are adding the gross national expenditure at the market price. It means with which the sum of the final private consumption expenditure plus the government final consumption expenditure plus gross domestic private investment, and together we can add the gross fixed capital formation plus the changes in the stock and net export or net export minus import. Together we can add to calculate the gross domestic product at the market price. And in addition to this, net factor income from abroad to gross domestic product from the market price will provide the gross national product at the market price. The second step. So we will be calculating the gross national product at the market price under the expenditure method we are using. And the income method, it is calculated, it is a sum of all income derived from the providing of factors of production. It is together included the wages and salary, rent, interest, profit within the country given period of time what have been received. So together it is calculated the income method. For arriving the income method, obtaining the net domestic product at the factor cost by summing up the factor payment paid in the form of wages and salary, rent, interest and profit by all factors of production for all the production unit of all the sectors in the economy, and add the net factor income from abroad for net domestic product at the factor cost to obtain the net national product at factor cost, or national income is calculated under the income method. So in income method it is calculated the gross national product is equal to the wages and the salaries received during the given period of time plus rent plus interest plus dividend plus undistributed corporate profit plus mixed income plus direct taxes plus indirect taxes plus depreciation plus net income from abroad. Together it is calculating the gross national product. And the value added method, in that the value added method, in order to value added the production should be calculated avoiding the double counting in each stage to arrive the gross national product. For that the particular purpose this value added method is used. So in that the value added method, the value added is defined as the difference between the total value of output of a firm and the value of input bought from the other firms. Together is calculated. So what would be the raw material have been used, what are the services have been added, or what are the process have been added, the value to the particular product, it is calculated in that two important method. The gross value added at the market price, it is calculated the value of output minus intermediate consumption sales plus changes in the stock minus intermediate consumption. Together it is calculated the value added method. The next one is the factors affecting the national income. So the important factors are affecting the national income, given more important to understand those factors and giving priority for control over the factor for effective management of national income. So the first one is the factors of production. Giving much important, there are scarcity of the resources which affects the productivity of the nation. So which may happen, there are resources if it is not properly available. So it is like a factors of production, land, labor, capital and organization. Together are the major factors of production. If there are factors are not available, or the factors are scarcely available, or the factors are expecting the rate of return is higher in the market, the kind of things which may affect the national income. Expecting the higher wages, or expecting the higher salary, or expecting the higher amount of rent, or expecting the higher profitability in the market. The kind of things are making a problem towards the calculation of national income. The technology, the adoption of technology, the upgradation of technology, the bringing the technology into the organization, or improving the productivity thereby using the technology. So with that, the technology is also the important factor for determining the national income. And the role of government is very important for determining the national income. So whatever the policies formulated by the government is going to make changes in the national income. So whatever the policies bring into the trade, bring into the overall changes in the economy, credit policy related changes by the government are directly affecting the firms, affecting the households, affecting the foreign sector in the economy. And the political stability is also play a vital role. If there is an instability in the political situation of the particular country, which may not attracting the foreign investment, though the investors are not ready to make investment in India. So if there is a kind of instability is prevailing, so if there is a stable situation is prevailing in the political situation, so the kind of income it will be increased in the particular market. So it is the kind of relationship with the political stability to the national income. There are corruption is also play a role. If the corruptions are reduced in the particular country, or completely eradicated in the particular country, is going to improving the overall national income, or the unaccounted money is going to be increased in the particular country, is going to make changes in the overall or the national income to the country. Difficulties in measuring the national income. There are some difficulties for understanding as well as to measure the national income. It is like non-market production. The kind of product, the kind of service is being provided, it is not comes under the organized sector. We are not able to measure the kind of output generated by those non-market production. The kind of product are manufactured, the kind of products are consumed within the particular local community. So it is not comes under the marketable product, or the production is not comes under the picture. So the kind of problem are there in measuring the national income. The imputed values. Sometimes what the people are using that particular product, it is not calculating the value. There are assumptions are taken for the calculation of value. So those assumptions are also become a problem. For example, if a person has purchased a house, so for purchasing house, they are calculating the rent. If I am going to rent out this particular property, what would be the rent might be received. So likewise, it is calculated for all the factors have been deployed in the particular organization. So there are problems in the imputed value. Either we have been calculated the higher value or the lower value. If it is being calculated the lower value, which is also going to affect the overall economy. It is like underground economy. There are a kind of a corruption or the black money in the particular economy is also affecting the national income. And the side effect or economic bads are also happen. It is like if one particular sector is going to increase, or that the income is generated by one particular sector, which may in turn affect the other sector. And so sometimes it may happen. It is like maybe a kind of a closed product, or like a substitute product, it may be affecting the kind of the effects in the market. Leisure and the human cost are also affecting the overall if the people are working, if the people are not working in the particular economy, it is not ensuring that all the people in the particular economy is working. So it may affect the overall productivity in the particular country. And the double counting, there may be the total value of goods and services has been calculated in the factor cost as well as it is calculated in the market price. It is like double counting effect are also there in the market. So the kind of things are very difficult for the calculation of national income. There are the uses of national statistics. It will be used for the purpose as an instrument of economic planning and review. For that the particular purpose, the policies, the kind of statistics related to the income will be used, and as a mean of indicating the changes in the country's standard of living. So what would be the changes in the per capita income, changes in the national income, changes in the gross domestic product or gross national product, deflator of GDP. Likewise, the kind of things we can be able to understand what would be the changes happens in the particular economy, and to indicate the changes in growth of economic growth may happen. So we know that what would be the percentage of changes happens in the particular economy. It is like if it is like 6% to 8% or 8% to 10%, we assume that it is like a 2% change or 3% change, or the kind of growth is able to measure. That way we need to have a kind of statistics for this particular purpose, as a means of comparing the economic performance of the different countries for that the particular purpose. So we know that what would be the export happens in the particular country, what would be the total income generated by the particular country over the period of time. Likewise, the kind of things are used for the purpose of comparing the economic performance of the different countries. So for this particular purpose, the use of national statistics, we can have the national income and related data is required for this particular purpose. So in continuation of that, in this national income, what are the things are essential what we have seen in this particular national income. So the national income is calculated the total value of goods and services produced in a particular country during a given period of time. So there are different concepts, different important concepts are used to calculate the national income. The kind of concepts are gross domestic product, gross national product, net domestic product, net national product, personal income, personal disposable income, per capita income are the major thing. So in that, the gross domestic product, it is calculated on the basis of the government expenditure, consumption expenditure, investment expenditure plus the exports minus import, the total value, it is calculated the gross domestic product. In that, the gross domestic product, in addition to this, if we add the net factor income received from abroad, we can get the total value of national product. It means gross national product. In that gross domestic product and gross national product, if you are subtracting the depreciation, it is a depreciation allowances towards the capital goods have been used for the purpose of production in that the particular country. For that particular purpose, we are allowing the capital consumption allowances, or otherwise call it as a depreciation allowances. So this we can get the net national product, net domestic product in the country. So we'll be calculating what would be the total income generated and what would be the portion of income contributed by the household. We call it as personal income. That the personal income together including the consumption expenditure and it is including the savings. If you are subtracting the savings from the personal income, you may get the total consumption expenditure from the household sector. And we are calculating the national income. There are different parameters are used to calculate the national income. It is calculated on the basis of the product method or output method, income method, expenditure method and value added method. So in this, the value added method is very powerful compared to other methods. In that the particular method, it is giving priority for or eliminating the double effects or double counting effects are eliminated in this value added method. Thank you.